Okay, good afternoon. Let's start. So today we turn to our last substantive topic for the semester, that is international finance. I believe that we do chapter 22 in your book. And there are a couple of things that we want to discuss here. Today we're gonna deal mostly with the foreign exchange market. So that's the main. Okay. So what is a foreign exchange market? It's a market for dealing in currency, trading different national currencies. We'll see how that works in international economic relations and how does that affect the flows of trade between different countries. We'll begin just by listing a couple of concepts that some of which we already analyzed, but that will be necessary to understand better international finance. So one of them is the concept of trade balance. So trade balance would be known also as a net exports. You now remember that we discussed our macroeconomic modeling. The net exports or trade balance is one of the components of GDP when you calculate by expenditure. You have consumer investment, government spending plus net exports. So trade balance is simple difference between exports and imports. Of course, then if this number is greater than zero, this is called, what is it called? Trade balance is greater than zero. Remember that this your export is greater than imports. Anyway. Trade surplus. And if this number is smaller than zero, it's trade difference. No. And that is actually talks about this. So these are the general concepts of international trade that are pertinent here. Foreign exchange market, that's another one, that's maybe the key one, is a market in which one currency is traded against another. And the main analytical concepts of this foreign exchange market analysis is called exchange rate. The exchange rate is simply the price of one currency in terms of some other currency. You need to pay whatever, $1 for, you need to pay $1.1 for €1, so then the exchange rate between dollar and euro is 1.1. That's the exchange rate is a key price of international currency trading. Now, there are two types of exchange rates. Today, we'll mostly base the entire analysis on the assumption that exchange rates are flexible. That means that they can change, they can fluctuate. So flexible or fluctuate. can change from one day to another, from 1 month to another, and so on. There are also fixed exchange rates. We'll say quite a bit more about them next time. Just one thing, one piece of information about fixed exchange rates. They're characteristic mostly of, or they were characteristic mostly of the gold standard system. So under the gold standard, gold is money, and different monetary units, different national currencies are just fixed quantities of gold or silver. So if you say dollar was defined as a certain fixed weight of gold, and the pound sterling is the same, just a different quantity of gold and silver. So then if you say, for example, that the dollar is 3.6 grams of gold, that's what $1 is worth. And the pound sterling is 7.2 grams of gold, then the exchange rate is 1 to 2. Simply it was 3.6 grams of gold or worth one half, 50% of 7.2. So these are just arbitrary, the national currencies used to be just arbitrary numbers, arbitrary weights and measures of gold, but the exchange rate in them was fixed in the same sense in which they couldn't fluctuate against each other. Nothing more than a mile can fluctuate against a kilometer, or a Fahrenheit can fluctuate against Celsius. Those are the measures that measure the same thing, just a different magnitudes. Kilometers. 1 mile is 1.660 meters. Cannot change. So then later on, when we went off gold standard, the currencies lost their connection with gold and silver, and now they're not based on any objective standard. They fluctuate. The value of any currency fluctuates with the supply and demand of that currency. And supply of any currency is determined how? Who determines the supply of money? How is the money supply determined? In most countries in the world, not all, most countries.
You're just talking about the central bank.
Yeah, central banks. Increasing or decreasing the money supplies. There is nothing inherent in the dollar. There is nothing real behind the dollar. You know it? It's just political and political willingness of central banks to increase or decrease the quantity. So then, in international economic relations, currency exchange is necessary for a variety of reasons. Can you tell me, why would an American, for example, buy Mexican currency, peso? What are potential uses? Use an American, in which type of situations, what type of situations you would buy peso, or euro, or any other currency, foreign currency?
I know that usually if you're planning to travel to that country.
Travel to that country. So why do you need any currency? Because you're going to be buying consumer goods for yourself. You need peso because of Mexico. What else? By you, I don't mean just you as individual citizens, any Americans, including business people. Why would business people buy peso? They buy much higher quantities of foreign currency than ordinary citizens. Why do they need foreign currency?
Because it's cheaper.
What is cheaper? Foreign currency. But why would an American businessman need Mexican currency in America? You buy everything in dollars. You cannot pay anything with peso.
They have like business partners in that country.
Those countries, so they need to buy something in that country. They need to import something. So the importation is the either component parts or final consumer goods you want to import whatever tomatoes from Mexico to sell here. So you need then to buy first Mexican currency and then to buy goods in Mexico, then ship them over to the United States itself. So you can say that there is a sequence here, logical sequence. That the demand for foreign goods, let's say demand, let's analyze America and Mexico. Demand for Mexican goods. We want to buy stuff from Mexico. There is a national border and there is a monetary sovereignty of Mexico. You cannot pay with dollars. You cannot just travel to Mexico and pay with dollars for the goods and services produced there. So you need Mexican peso. So then the demand for Mexican peso leads to demand for Mexican goods, I'm sorry. So leads to the demand for peso. Mexican currency. Now you're on the international exchange market, currency exchange market. Americans will buy pesos in order to buy Mexican goods. What they offer in exchange? It's exchange market. What they buy pesos will.
Euro.
Yeah, dollars. So it's the supply of dollars. Right, supply and demand analysis. And the opposite applies to Mexican buyers. You have a demand for American goods, you're gonna buy American dollars, you have a demand for American dollars, you're gonna supply in exchange Mexican pesos. So it's just a flip analysis. It's the opposite. Demand for US goods leads to the demand for dollar and leads further to the supply of pesos. That's the basic framework, that's the basic logical sequence. Everything else is just the fine refinements and sometimes necessary, sometimes unnecessary complications. But this is the basic structural argument, that's what's going on. And eventually you will be using your dollars to buy stuff. And this intermediary step is necessary only because there are national borders, so you have to make a conversion for currency. Now let's use a simple supply and demand framework to see how the exchange rate is determined in the market. Let's assume that we talk about demand and supply of pesos. That would be the supply and demand of dollars. It's just the flip side. Let's say that we analyze the peso. You have a price and quantity, like in any other supply and demand framework. You have a quantity of pesos. Here on the horizontal side, you have a price for peso in dollar terms. How many dollars you need to pay for a peso, which will be the exchange rate. This price is the exchange rate. Peso against dollar. So now you have then, like any other supply and demand framework, you have a demand curve. The higher the exchange rate, less pesos will be demanded. More dollars you need to pay for a single peso, fewer pesos will be sought after or demanded by American citizens. So let's say you have the exchange rate, use the examples with you, doesn't matter. Let's say that the exchange rate you need to pay $10 for a single peso. That would be whatever, 100 pesos would be demanded. If the exchange rate goes down 0.08 or 8 cents, $8 per peso, then the quantity of pesos will be increased, whatever it is, 130. Americans will want to buy more Mexican currency if the exchange rate is more favorable. And then you have the supply of peso, which is just like any other supply curve, is proportionately related to the price, to the exchange rate. Higher the exchange rate, more currency you would offer. If you can get $8 per peso, you will offer less than if you can get $10. That's the basic logic of a seller who wants to sell more stuff if the price is better. So then what is this point here? The intersection of those two curves. That would be the prevailing or equilibrium exchange rate at which all conversions will take place. Some average. There will be some variations like that, but in principle there will be a very strong tendency towards one single exchange rate. Equilibrium exchange rate. So this analysis, just to reiterate what might be obvious to you, applies only if you have a flexible exchange rate regime. The gold standard, this doesn't work because the exchange rates do not change. Supply and demand. Exchange rates will be what they are. Just one currency, just gold. There's no exchange rate between dollars in New York and California and North Dakota. That doesn't make any sense. It's just one currency. So this analysis applies only if you have multiple independent currencies controlled by multiple independent central banks that pursue their own independent monetary policies. So now what's going to happen if, for whatever reason, you have a disequilibrium, that the exchange rate departs from the equilibrium for a while? Let's say it's slightly higher. You're describing this situation. Let's say that 10 cents per peso, $10 per peso is the true equilibrium exchange rate that corresponds to the conditions of supply and demand of both currencies. And for whatever reason, temporarily on the market, the exchange rate increases to 15 cents. What's going to happen in that type of situation to the quantities of both pesos gold? So the supply of pesos, this is the diagram that depicts demand for and supply of pesos vis-a-vis gold. So if the exchange rate against dollar increases, then you have quantity supply of pesos will exceed the quantity that is demanded. So this is quantity demanded, this is quantity supply. Quantity supply will exceed quantity demanded. That's called in economic analysis surplus. So whenever surplus of anything shows up, you can bet that the best and the most straightforward way of fixing the surplus is that the price will have to go down and to eliminate the surplus. So the exchange rate will have to go down. So this is the surplus of pesos. So then the people who have pesos will have to offer, in order to sell, if they want to sell their currency to Americans, they will have to offer more favorable terms, lower exchange rates. They have to be ready to accept fewer dollars for a single peso if they want to sell. And vice versa. If exchange rate goes down here, below the equilibrium, then the opposite will happen. The quantity demanded will be greater than quantity supplied. So this is quantity demanded, this is quantity supplied. So then the opposite happens. then more Americans want to buy peso, and there is an available quantity out there. So in order to induce more Mexicans to offer more currency for sale, they will have to offer better terms, which means higher price, higher exchange rate. So this is a shortage of this. It's sold by buyers who are in an inferior position, have to offer concessions in terms of being ready to pay a higher price. Just the same basic supply-demand, shortage surpluses analysis applicable to any other market. So the price will have to go up until the equilibrium point. The market clears. There are no shortages if there are no services. So there are two technical terms for the changes in the exchange rate. If the value, for whatever reason, on the free market, because we know that supply and demand fluctuate, move up and down, left and right, so that means that the exchange rates on the market change all the time. If the exchange rate dollar against peso goes from $8 cents to $10 cents, what is this called? Which currency increases in value? If the exchange rate goes from 0.08 to 0.1. Which currency increases in value vis-a-vis other currencies? Peso. So this is called, from the perspective of dollar, this is called depreciation. That means that losing value, losing ground vis-a-vis other currency. You need to pay more dollars for the same quantity of pesos. That means the dollar appreciates. And vice versa. If equilibrium exchange rate goes down from 0.1 to 4.08, that means that now you have to pay fewer dollars for the same quantity of pesos. 1 peso. That means the dollar appreciates, increases in value. Increasing value. So now you have international currency markets with all the elements that any other market has. Like a commodity market, you have speculation. In commodity markets, you have speculation in currency markets. People try to predict the monetary policies. People try to predict the factors that will influence supply and demand of currencies in the time to come. So they buy or sell different currencies in order to earn profit. Arbitrage of the price spread between the current price and higher or lower price later on. If they predict the depreciation of currency, they're gonna sell right now, or if they expect appreciation in the future, they're gonna be buying currency and so on. So there is an entire part of financial markets, speculative financial markets, international currency. And we know already that speculation is a very useful market invention that tends to reduce the fluctuation in prices, to stabilize the market, because whenever there is some disconnect between the existing prices and the underlying conditions on the market, speculators will try to take advantage of that. And by doing so, they're going to reduce the price spread. They're going to speed up the process of readjustment. That's one consideration that we will not go into great details right now. This is just a basic introduction. That's a topic for financial markets, of course, how the exchange markets work in technical detail, how speculation works to streamline the process of market adjustment. We're gonna mention here just two important factors that influence the exchange rates, or changes in the exchange rates. So these would be one of them would be variations in income. So if two countries, let's say United States and Mexico, if their GDPs grow at different pace, if one country is wealthy is increasing faster than the other countries, well, that will influence the demand and supply of currencies in the exchange rate. One simple example of that would be the same graph as before. Is pesos. We have some initial equilibrium, supply and demand, equilibrium exchange rate. Here, and let's say that in the United States, so this is demand and supply of pesos in dollar terms. Let's say that the United States grows faster than Mexico. Has higher growth rate. That will increase American income. And by increasing American income, it will increase the demand for both foreign and domestic goods and services. Have more money, you can buy more stuff. So that means that the demand curve on the side of Americans for Mexican goods will increase. Remember the whole sequence. Demand for Mexican goods increases because we are wealthier, we have more money, because our growth rate is higher. That means that the demand for pesos will increase because we need more. We spend more on both on domestic and foreign goods. But when it comes to foreign goods, the demand curve shifts to the right. So this demand for foreign currency will then increase. If you assume that the supply of peso hasn't changed in comparison with supply of pesos, you will have an increase in exchange rate. Exchange rate 2. The country that grows faster will have its currency depreciate relatively to the country that grows slowly. The exchange rate will go up. You will need to pay more dollars for the same quantity of pesos as before. And vice versa, if Mexico starts growing once again, then the demand curve for peso will go to the left. The demand curve for dollars will go to the right. So that means the basic conclusion that variations in income influence the international exchange market in such a way as to increase the exchange rate or to depreciate the currency of the country that is growing faster. But in this particular case, only the demand is, if we assume that monetary policy hasn't changed, only the demand conditions are affected. But there is another and much more commonly present factor that influences the exchange rate. That would be variations in inflation rate, the price level fluctuations. Let's say relative price level effects. That simply means that if two countries have different inflation rate, that will affect the exchange rate between their currencies. So now we're trying to make a connection between this narrowly macroeconomic concepts, inflation rate in America and Mexico, then the exchange rates between the currency, and then in the third step in the flow of goods and services between them. They go from inflation, which is a domestic issue, then exchange rate, then real goods and services. So again, the same framework. Yeah. Price exchange rate in dollars, quantity of pesos. You have some initial demand curve, you have initial supply curve of pesos, you have the quantity of pesos that and you have the exchange rate one, price one. So now let's assume that both countries have inflation, but that the American inflation rate is 10% higher than Mexico. How will that affect supply of pesos and demand for pesos? So USA has a high inflation rate in Mexico, 10%. In order to simplify it, we may assume that Mexico didn't have inflation at all, and here it was 10%. What do you think? What's going to happen to the demand for pesos on the part of Americans? And why?
Will it go down because they don't have as much value in US dollars?
The demand for pesos will go down. Okay. Because
The US dollars aren't worth as much compared to
don't you want to have more of the stuff that is more valuable? So dollar lost more value in terms of inflation. Purchasing power of dollar went down, whereas peso remained the same. So imagine you're a businessman. You're deciding about how much your business community in America, how much to buy here, how much to buy from Mexico. Let's assume that those are the only two countries. How your calculation will change if the price level in Mexico remains stable and increases 10% here. That's it. Across the board, increasing prices 10%. On average, how people start thinking. Everything else remains the same quality of product. We're going to control for all other potentially confounding variables. We're going to say nothing else changed. Just the price level increased 10% here. How will that affect the motivation to import stuff? American goods are getting more expensive, Mexican goods not. It means that Mexican goods are getting relatively cheaper and cheaper vis-a-vis American goods. Because American CPI, American price level increased 10%, in Mexico remains stable. That means that everything in Mexico is relatively cheaper than it used to be before. So then more people in America would want to import stuff from Mexico because it's cheaper. And it's cheaper because the price level here increased much more than in Mexico. So that means the higher demand for Mexican goods. Higher demand for Mexican goods leads to what? How does that affect demand for peso? Increases. This is a new demand curve for peso. This is the Americans. USA demand. Now take a look at the same situation through the lenses of a Mexican entrepreneur. You're also importing and exporting to and from the United States. Now the price level there, the United States increased. In Mexico it remains the same. How would you react on average?
Would you be expecting to export more? Because US prices are higher
Yeah, to export more and to import less.
Yeah.
So you're going to be buying more dollars. You're going to want more dollars, but when it comes to supply of pesos, do you reduce or increase the supply of pesos? So American goods, from your point of view, are now cheaper or more expensive? More expensive. So you will tend to import less stuff from the United States. In order to import from the United States, you need the dollars. Your supply of pesos equals demand for dollars. So your demand for dollars decreases, which means your supply of pesos decreases. People have less motivation to buy American dollars with their pesos because they have less motivation to buy anything in America because everything is more expensive. So that means, what it means that the supply curve of pesos starts shifting to the left in the opposite direction. So the demand curve shifts to the right, increasing demand for pesos. Supply curve will shift to the left because Mexican business people have less motivation to exchange their currency for dollar, since everything is more expensive in America. So they're going to reduce their imports. What will be the new equilibrium? Demand curve 2 and supply curve 2. Here, it will be the same quantity of pesos as before, exchanged, but at a higher exchange rate. That means we'll give you as much peso as you want, but you will have to pay more in dollar terms. So this process is called purchasing power parity adjustment. PPP. And it says one simple thing. Whatever country inflates faster, the value of its currency will have to depreciate roughly the same percentage that it inflates relative to other countries. So that means if the difference in inflation rates in the United States and Mexico is 10%, then the American currency, meaning Americans are inflating 10% more, that means that exchange rate will have to decrease 10%, American dollar will have to decrease 10% vis-a-vis. That's the kind of adjustment that will take place in financial markets. So you can inflate if you think that will help your country, but that will make inflation will make your export less competitive and import more attractive to you. Americans will be importing greater percentage of their national income will be imported if inflation rate in America is higher than in Mexico. And vice versa, if you have a low rate of inflation, then your business partners, your export industry will be stimulated. Because foreigners will want to buy more of your stuff, which is cheap. So I see low inflation rate, high export, and relatively lower imports. So trade balance changes. Trade balance tends to increase when you have a relatively, the key term here is relative. It doesn't matter. In and of itself, it doesn't matter how high in absolute terms your inflation is, as long as it is lower than the inflation rate of other countries, you will have this export boost, and vice versa. It doesn't matter how high your inflation rate is in absolute terms, 5, 10, 15, 200,000%, as long as if it's higher than the inflation rate in your business partners, you will have your export reduced and imports increased. So this is one of the mechanisms for automatic adjustment of the international economy. One of the reasons why in an open market economy, it's not so easy to inflate your economy is exactly this, the foreign exchange market repercussions of inflation. That you will start, that your export industry will start suffering. You will accumulate a large trade deficit as a consequence of that. There is one more aspect of this story that is necessary to mention. By the way, are there any questions?
So as a producer, you kind of want to see other countries' currencies inflate then, is that correct? Because you increase your
As an exporter.
yeah, as an exporter.
As an exporter. As an exporter. So you want a lower inflation rate in your country if you're an exporter. That's the key. Or lower inflation rate in your country vis-a-vis other countries. So see here, it doesn't matter. Let's say that you have a 6% inflation rate here and 6% in Mexico. Very little will change. But if you have 7% here, and no, let's say 3% here and 1% in Mexico, that will have much more substantive effect. Or vice versa, 1% here and 3% in Mexico. So what matters is the relative price level effects. Relationship between the two inflation rates, not any single inflation rate. Anything else? One more thing that we have to take into account here, which is not a monetary phenomenon, but it influences international financial markets and international trade, is the variations in interest rates. And by interest rates, I mean real interest rates. So what are the real interest rates? You can say, in principle, in general, there are three components of interest rates. Nominal interest rates, the interest rate that people pay. One of them is inflation, expected inflation. So let's say that the interest rate is 4% otherwise, and then we expect 2% inflation rate, and the nominal interest rate that everybody would be paying is 6%. 4 positive. This 4 is the real interest rates. That's the interest rate on the market control for the inflation. That we eliminate inflation. That's the real interest rate. What determines the real interest rate? Two things. The first is the social rate of time preference. That means simply how impatient people are about the future. I lend you $100, you're going to return 103. And one of the main reasons why you have to pay me principal plus interest is that future money that I'm going to receive in 3 months is less valuable than the present money. So there's this mismatch between present and future. We prefer present to the future always. The same dollar today is worth more than $1 in 3 months. So then the interest rate, one of the aspects of interest rate is that it compensates for losing income or losing value by lending money. So that's the rate of time preference. How much we are impatient about the future. If we are more impatient, then the interest rate will be higher. Somebody will need to pay us more in order to lend a dollar. If you are less impatient, it will be less. And the second component is the risk, systematic or individual risk. So whatever my rate of preference, then there is a risk, default risk that you're not going to pay back. So then another component of the real interest rate is the risk premium, or risk compensation. It's the premium for bearing the risk or uncertainty of possible default. So then different countries have different real interest rates. Let's say that the social rate of time preference, it's difficult to measure it. We don't know what it is, but it doesn't, in all likelihood, vary so much from one place to another. But what varies very much is the risk component of the real interest rate. So then if you have a far less risky economic and political environment, your real interest rate will be far lower. And why is that good for you? It's good, of course, because your people will have the ability to borrow more money at more favorable terms, and that will stimulate your domestic economy as well. So in most international transactions, financial and otherwise, there will be a tendency for the transfer of wealth from high interest rates countries to lower interest rates countries, if this difference is determined by the different levels of risk. So you have a movement from Russia to America, people moving money from Russia to America. So then this variation in interest rate is a proxy for the variation in risk. People prefer the low risk environments, and when real interest rates are different, that's typically because the level of risk in one country is lower than in another. So that also influences the international distribution of capital. That's the reason. That's one of the main reasons why, like 80 to 90% of capital transactions or capital investment is between developed countries, between Europe and America. It's much more money goes back and forth between the European Union and America than between America and China. Way more. Exactly because of this situation. A negligible part of the international capital markets is in very poor and unstable countries. And they have typically very high interest rates on commercial loans, high interest rates on commercial loans. Okay, it would be any final questions? So next time is the last lecture this semester. It's about the fixed interest rates. We'll finish with that. And then on Friday, we will have an overview of the whole thing for the final exam. Prepare for that. I will give you one hint. In the final exam, I will put a lot of emphasis on international trade and international financial movements. So the last two topics will be important. I don't like that particularly. And the final will be one day during the week, during the exam week. Whatever, I haven't determined it yet, but it will be one day from 9 o'clock to, let's say, 4 or 5 p.m. So if you want me, I can determine that right away, or we can. Today it's 11th or 12th. 19th, 20th, 19th or 20th, one of those 2 days. I can move it a few days later on. But my experience is that if I try to follow well, there are so many different ideas and you cannot satisfy everybody, so eventually I will have to just decide.
Thank you.
Yeah.